Welcome to our CFP exam prep discussion focusing on investment options, a crucial topic that frequently appears on the exam. Today, we're diving deep into various investment vehicles and their characteristics that you absolutely need to master. Let's start with stocks, which represent ownership in a company. Many candidates mix up the key characteristics of common and preferred stocks on the exam. Common stocks give shareholders voting rights and potential dividend payments. But remember that preferred stockholders have priority for dividend payments and assets in liquidation. A common mistake is forgetting that preferred stocks typically have fixed dividend payments, making them more similar to bonds in terms of income characteristics. Speaking of bonds, they're debt instruments that require special attention. The relationship between interest rates and bond prices often trips up test takers. When interest rates rise, bond prices fall, and vice versa. This inverse relationship is fundamental. Here's a practical example. If you hold a 5% bond and new bonds are issued at 7%, your bond becomes less valuable because investors can get better yields elsewhere. Pay close attention to duration too. A bond with a longer duration will be more sensitive to interest rate changes than one with a shorter duration. Derivatives are particularly challenging for many candidates. Options and futures are the most tested derivative instruments. With options, remember that a call option gives the right to buy, while a put option gives the right to sell. Students often confuse the payoff diagrams for long and short positions. For instance, when you buy a call option, your maximum loss is limited to the premium paid, but your potential gain is theoretically unlimited. This is different from selling a call option, where your maximum gain is the premium received, but potential losses could be substantial. Pooled investments, including mutual funds and ETFs, require understanding both their structure and tax implications. A common error is not recognizing the key differences between open-end and closed-end mutual funds. Open-end funds can create new shares to meet demand, while closed-end funds have a fixed number of shares trading on exchanges. Another frequently tested concept is the calculation of NAV, net asset value. Remember that NAV equals total assets minus liabilities, divided by the number of shares outstanding. When it comes to risk and return profiles, the exam often tests your ability to match investment vehicles with client objectives. For example, a growth stock typically offers higher potential returns but comes with greater volatility, while a government bond provides lower returns with higher safety. Students sometimes forget that risk and return exist on a spectrum, and there's no such thing as high returns with no risk. Here's a crucial concept breakdown for investment options that often appears on the exam. Traditional investments like stocks and bonds form the foundation, with stocks generally offering higher potential returns and higher risk compared to bonds. Derivatives serve as risk management tools or speculative instruments, requiring a deeper understanding of leverage and market mechanics. Pooled investments provide diversification benefits but come with their own costs and tax considerations. Remember to always consider the tax implications of different investment vehicles. For instance, municipal bonds offer tax-free income at the federal level, while corporate bond interest is fully taxable. Additionally, pay attention to how different investment vehicles handle capital gains and losses, as this is frequently tested on the exam. By mastering these concepts and understanding common exam pitfalls, you'll be better prepared to tackle the investment options section of the CFP exam. Stay focused on the relationships between risk, return, and tax implications across different investment vehicles, as these connections often form the basis of exam questions.